Hello to everybody that's joining so far. It's about 1 o'clock. We're going to give everybody a few more minutes or a couple minutes to log on before we start making our announcements. Looks like we have a lot of people coming on today, which is great. Going to give it another 30 seconds. That should be enough. Well, good afternoon or good morning to everybody, depending on where you're calling in from. And welcome to our Year 15 2021 Transition Strategies for Expiring LIHTC Properties, our 2021 version. This is our first Zoom presentation of this. We've done this in other formats before. So given the sign of the times, we're going to do it in the Zoom format now. Just a couple of housekeeping items. We do have a Q&A button on your screen. You can ask your questions. The chat button there, you can enter in perhaps where you're calling in from, what your interest is. That's how we'll develop a sense of community over the next hour and a half. We may answer some of the questions during the presentation if they're relevant to the slides that we're looking at, or we may wait till the end of the presentation. But we will get to your questions to the extent possible. So it looks like the logins have slowed down. So I think we'll probably have most of the attendees that we're going to have. So I'll go ahead and get started. So my name is Sean Barnes. I'm a senior manager in the asset management department of Enterprise. My focus is primarily on Year 15 dispositions. I'm a member of the Year 15 dispositions team, and I'll be leading most of the presentation today. Laura Turner is our director in our asset management department. She leads our Year 15 team. And Laura will be facilitating the questions today and providing some answers and generally monitoring the question flow as we go along. And then Erica is going to join us as our accounting expert. Erica is a senior regional accounting manager for the central and east regions of the country. And we lean on her heavily on Year 15 for accounting questions, but also liquidation calculations and capital count estimates and so forth. So her team is very integrated with ours throughout the Year 15 process. The overall objectives of the training. Today, we're going to try to give you a brief overview of what the Year 15 process is. We'll dig into some of the items deeper than others. In particular, we will look closely at the right of first refusal and the buyout options and some other hot button items that come up at Year 15. We'll want to understand the stakeholders of the viewpoint of the stakeholders, what their perspective is on Year 15, what their motivations are at Year 15. And that's a very important component when it comes to negotiating through the process if a negotiation is involved, or really even just speeding up the process and making it more efficient if you understand where your other stakeholders are coming from and what their needs are. We will touch briefly upon re-syndication, if that's an avenue that you want to take at Year 15 to recapitalize your project if necessary. Erica is going to take us through the capital counts and the exit tax calculations. And then ultimately, we're going to go through like a broad overview of how to develop a action plan to take your project through the Year 15 process. And in doing so, at the end of that, we'll go through 2 case studies, which are actually live deals that we just closed on in the last couple of days, really. That'll hopefully highlight everything that we learned throughout the presentation in real life. So nationally, our affordable housing stock has grown to over 3 million units through this program. These units are spread out across the country in urban, suburban, and rural markets. They serve low-income seniors, low-income families, people with special needs. And a few years ago, HUD did a study that really focused on the national affordable housing stock. And what they came up with, it 64% of the residents are at or below 40% AMI or area median income. And what that tells us is there's a very strong need that's being filled in the low income housing markets. So the program is very successful, but a lot of these assets are coming to the expiration of their initial compliance period, but also the extended use period is approaching, and some of these properties are coming out of their extended use, their additional 15-year extended use period, or perhaps it's a 30 or 40 or 50 years or 99 years in some locales. But more and more of these projects are coming out of their extended use period, and this is going to present some challenges for providing year 15 housing across the country. And Enterprise, fortunately, does have some considerable experience with the year 15 process. We've gone through over 1,100 dispositions, projects have been disposed of since our program started. And we have some pretty good job security here with Enterprise. We have roughly 100 projects that are going to be exiting year 15 over the next 5 years, so 100 projects annually. So we're going to be really busy, as we have been for the past several years, going through the year 15 process. So we do have a mantra at Enterprise that we start out with when we are first addressing our general partners and our sponsors, whether it be in a training session like this or actually talking to them when they approach us about the year 15 process. Number one, you want to understand your property. What are the capital needs? What does your income look like? What's your cash flow look like? What's the health of your property? What needs do you need to have filled and get accomplished in the year 15 process? Because as you'll see, when we're developing this plan, we want a plan that's not only going to take us through year 15, but it's going to take you through your extended use period and forward, because you want the property to be healthy going forward. Number two, you do want to know your partners and your stakeholders. Get to know them. If you're approaching year 15, we highly recommend you reach out to your investors, whether it's through a syndicator or a direct investor. Pull out your documents. Number three, dust off your partnership agreement and your loan documents and read through them, especially the partnership agreement, because that will outline what your rights are at year 15, what you can and cannot do, what type of price you might have to pay to get the limited partner out, et cetera. And then ultimately, after reviewing the mantra, if you will, you'll develop your plan going forward. And the earlier you start this process, the better. And we'll be highlighting that a lot through this training. It's never too late to start it, but it's a lot easier if you get started earlier. So these are the stakeholders. Obviously, our residents are extremely important to us. That's why we got in this business. There's a lot of general partners and developers that are on the phone today. This training will be very relevant to them, obviously, if they're approaching the year 15 process. Investors and syndicators are very important. Obviously, we need the capital available to develop these projects. You may have public and private lenders involved, and each of those type of lenders presents their own challenges. In particular, the public lenders may have certain consent rights for the year 15 process that you want to be aware of. So the sooner you can reach out to that stakeholder, the better as you're approaching year 15. I would recommend starting with reading the loan documents, but then also pick up the phone and make a phone call, because it can be a slow process. And it can come down to just staffing issues at these lenders or their backlog, but it can take a long time to get through the lender approval process. So you want to get that started sooner rather than later. Obviously, allocating agents are very important in the beginning, and they're important at year 15, especially if you want to do some type of re-syndication plan. And then, of course, the IRS is a big stakeholder. They want to make sure that all the rules have been followed, and there's no recapture events, et cetera. So this slide presents how these deals are typically structured. At Enterprise, we call it an upper tier and a lower tier. The upper tier consists of the fund, which is made up of a general partner and a limited partner. Now, what's important about this slide, I think, is the roles that everybody plays. So in the equity fund, Enterprise, as a syndicator, is the general partner. We manage the day-to-day activities of the fund, if you will. The investors contribute to capital, and they are the limited partner in that equity fund, but Enterprise drives the day-to-day business. In the lower tier, Enterprise, as a part of the limited partner, does not drive the day-to-day business. The general partner does, the developer, the sponsor. So they take care of the day-to-day operations. That's important for a couple reasons. The role reversal, if you will. The general partner will have certain rights in the partnership agreement to carry on the day-to-day business, but the limited partner will have certain rights that are spelled out in the operating agreement or the partnership agreement as far as the disposition goes. Maybe the partnership agreement will spell out the price that should be paid if you have a buyout option or a right of first refusal. But the limited partner will also have consent rights over such things as refinancing or sale of the property, et cetera. So it's nice to get a clear understanding of where the role reversals are. If you do have a syndicator involved, the syndicator acts as the go-between with the investors and the developers. So if we come to an agreement internally of where we should go with a certain disposition, we may or may not need consent from the fund, from the upper tier. And that can delay the process. It can also make it more challenging. So in the beginning of your conversation, perhaps with your syndicator about year 15, you want to get a better understanding of who the investor is. Is it a multi-tier, a multi-investor fund or single investor, et cetera. And these deals are structured either typically as a partnership, limited partnership, or a limited liability company, an LLC. Now, from my perspective, that doesn't make a difference whether it's a LLC or a limited partnership. Each will have its own style of document, if you will. The partnership agreement will have, the limited partnership will have a limited partnership agreement, and a limited liability company will have an operating agreement. But both of those documents will cover certain key items, including the transfer restrictions, what type of consents are needed, the price, and also the distribution of the proceeds if there were to be a liquidation event, either hypothetical or actual. And I'll explain that a little bit later in more detail later on, but we're going to talk about buyout options and rights of first refusal. And ultimately, in either one of those, if you're going to calculate what the price is per those articles, the buyout option or the right of first refusal, you'll follow a certain waterfall that's indicated in your partnership agreement. And ultimately, when you go through that waterfall, you'll come up with an amount where who gets what, if you will. The limited partner, how much they get, the general partner, how much they get if there was a liquidation event and there was value in excess of debt. But we'll go through that in a few slides. Several different types of investors. Sometimes we have direct investors, or you may have a direct investor. Enterprise is a intermediary or a syndicator, if you will. We have single corporate investor funds. We have multiple corporate investor funds, and we also have multiple individual investor funds. And the types of syndicators across the country vary. We have national nonprofits and national for-profits, and we also have regional nonprofit, typically nonprofit syndicators. Now, our goals at year 15 are pretty much standard across the industry, I think. Obviously, we want to make sure our investors have received what they were promised in year one, because we want them to keep investing. So make sure their benefits have been delivered. We try to time the exit to occur early in year 16. So we'll reach out to our general partners early in year 14 if we haven't heard from them yet, to get the ball rolling so that we can be queued up to exit early in year 16, because there's no reason really for the limited partner to be in these deals after the first day of the year 16. There's no more fiduciary responsibility, no more financial responsibility. And it gives the general partner more flexibility to conduct business going forward without having to get the approval from the limited partner. Ideally, we like to transfer to our sponsors. They've been with the projects for 15 years. They understand the property. They're probably mission-minded. They've been in the business with this, been married to this property for 15 years, and they understand the needs going forward. So that's our primary goal. I mentioned in that earlier that about the HUD study, they found that over, I believe it was 80% of these transactions are transferred to the existing general partner, existing sponsor. So that's typical in the industry. We do work with the sponsor to help develop the plan and training such as this, but obviously we'll also reach out on the phone or via email and have the conversations early about any kind of questions the general partner has, and to kind of demystify the whole process of year 15. We want to preserve, ultimately we want to preserve affordability and avoid the displacement of low-income residents. That's paramount. And we can do that by making sure that the project is viable going forward. Economically, we're not just going to throw the keys at everybody. You know, it's we want to look at, help them develop a plan that's going to keep the project healthy and viable going forward. And to do that, Enterprise does have certain equity products available to re-syndicate your project if that's your goal. And we have several debt products through Bellwether Enterprise and the Loan Fund to provide debt to these projects. Now, the reason year 15 is important is these deals were envisioned by the investors to be 15-year investments. And technically they can get out, they can transfer their ownership in year 16 without recapture. I say technically, that's reality. You can exit after year 16, day one of year 16 without a recapture exposure. And most of these investors are already willing and able to get out year one of of year 16. So from the investor side, they're typically ready to get out. And from the general partner side too, like I mentioned earlier, they want to be more nimble and they don't have to worry about getting approvals from their limited partner. And if there's no compelling reason to keep the limited partner in, then why not get them out of the way? So everybody's pretty much poised to get the limited partner out by year 16, beginning of year 16.
And Sean, we have some relevant questions in the chat. Two individuals who have expressed concern about limited partners who may not be interested in leaving their year 15 projects and how that can be handled.
So obviously the first place you look is your partnership agreement. Is there any kind of put agreement in there? And I'll talk about that a little bit later in the training, but the put agreement would basically say, hey, you have to do this at this point in time. Year one, you have to sell the property, or excuse me, year 16, you have to sell the property. Or you have to limit a partner, you have to sell your limited partner interest at a predefined price. But ultimately, it's going to come down to a negotiation if it's not in the partnership agreement. And negotiations can be tough, but if it's not outlined in the partnership agreement, you're going to be stepping outside of the agreement. And if the limited partner, for whatever reason, doesn't want to get out, then it comes down to a conversation perhaps with your legal staff and to determine what your rights are. But most times we don't see that happening, but I do hear about across the country different syndicators and projects where that becomes an issue. And again, it comes down to a negotiation.
Yeah, and I can add, Sean, I agree. We have not seen that in our portfolio. Our investors have been eager to exit partnerships at the end of year 15. And we have a slide later on, it's called Back to the Future.
Yeah.
And that's another good place to kind of address, as you're closing new deals, what are the options being put into your limited partnership agreement that guarantee you some option to pull the trigger on getting your investor out at the appropriate time?
Right. And nowadays, new deals that are being written, it's become increasingly apparent that year 15 is a really important part of the equation when you're putting a new deal together. You want to, 15 years goes by really fast, and you want to know what's going to happen at year 15. Often I'll hear when we get having the first conversations with a general partner, they say, hey, 15 years ago, we never thought this thing would have value, or we never thought this was going to happen. But so 15 years flies by. So earlier you plan, including in day one or year one, the better. So as far as determining when year 15 is, and surprisingly, I do get a lot of questions about this, but they begin on the tax credit compliance period ends on the last day of the 15th year the credits were taken. And again, that's the last day. So it's 12/31 of year 15. If your project was placed in service in July, and you start taking credits that year, it still ends at the end of year 15. You wouldn't end, the compliance period does not end in July, it ends at the end of December of that year. If you have multiple buildings in your project, your year 15 may be different. So you want to plan the disposition for that project that has multiple buildings in year 16 of the last building that was placed in service. So the last building that was placed in service, that's when you count year 15. So if you have 4 or 5 buildings and number 5 was placed in service in such and such a year, that's the year that you use to do your calculations for year 15. And the way we do the calculation is pretty straightforward. Here in this example, we have tax credits that were allocated in 2004. The building was placed in service in 2005, but the partnership elected to begin taking credits in 2006. So you can use your fingers and toes and start counting from 2006 up 15 years, including 2006 till you get to 15 years, and that will be 12/31 of 2020. Or you can just take that first year, 2006, and add 14 to it, because 2006 is year 1. Add 14 to 2006, and you get the year 2020. And that way you don't have to take off your shoes and socks and count. That's the number. So it's pretty straightforward. It's just the year that you first took the credits and add 14, and then you're in year 15. And you're eligible to dispose of the limited partner in day 1 of year 16. Now, possible scenarios for getting a limited partner out. 2 of the most frequent scenarios that we see are the right of first refusal to purchase the real estate or to purchase the property. And it's a really important distinction here. The right of first refusal is to buy the real estate, buy the purchase or the property. Then there's a buyout option to acquire the limited partner interest in that partnership and property. And we're going to go through in detail in our training here on both of those scenarios because they are very relevant. Most of our agreements will have 1 or 2 or both of those options in there. I think once or twice I've seen they didn't have it, but that was a really early deal. But typically you will have one of those 2 options. Now, we provide this training across the country and sometimes in person on a 2-day event where groups actually bring their deals to us. And I have seen several partnerships outside of or projects outside of enterprise portfolio that don't have an option. But I've also seen deals that have put which is an obligation to purchase at a predefined price. Enterprise deals does not have or do not have puts in their agreements. But if you do have one, that's another really strong reason to read through your partnership agreement. That may dictate, it may limit you as to what you can do at year 15. If there's a put agreement, it may say, hey, you have to sell the real estate on such and such a date and liquidate the partnership, or you have to buy the limited partnership at a certain predefined price. So outside of a put agreement, you'll have the 2 most prevalent methods of getting limited partner out. If there's value in excess of debt, will be the right of first refusal and or the buyout option. You can also purchase the property or purchase the interest within the initial 15-year compliance period, and we call that an early exit, which we're going to talk about a little bit in this training. And obviously, ultimately, you also have the option, the partnership has the option to sell the real estate to a third party. We very rarely see that unless it's like a resyndication, but technically it's a third party, but it's not really. There's probably some related people there. But from time to time, it does come up where I'll talk a little bit later in the training about the general partner's motivation to stay in a deal. Maybe they don't want to stay in the affordable housing any longer, and there's one reason or other want to sell the partnership property. That's an option in your partnership agreement as well. So the right of first refusal is what sometimes is termed the sweetheart price. Per section 42 of the tax code, it gives the holder of the right of first refusal the ability to buy the property for debt plus taxes. Now, some of the older deals, we also had debt plus taxes plus unpaid benefits. This is a minimum price that's set out in the code that the holder of the right of first refusal can buy the property for. Now, for typically a group that holds a right of first refusal for a property that has value, that gets them very excited because you're going to get the property at a sweetheart price, but there are some issues that come up. And some of them you probably heard about in the news nationally that are hot button items for our industry and some issues that have to get resolved. Some of the issues in the right of first refusal include, number one, is a third party offer required? Now, it's implied in the code that it is, but this can be really problematic if you think about it. If your property is value, your property exceeds debt, so this right of first refusal looks really good for you, and you hold the right of first refusal, but you have to get a bona fide third party offer. Well, it's going to be really hard to get a third party out there in the market to make an offer on this partnership property that they ultimately know they cannot get because you hold this right of first refusal. You're going to beat their price because it's going to be below what the market value is. So a third party is not going to make an investment in time and money and due diligence to make an offer on a property they can't get. So it can be problematic to get that third party offer, bona fide third party offer. Enterprise, for the sake of our investors and for the sake of our tenants and for the sake of our general partners, we do not require that third party offer. The holder of the nonprofit or the right of first refusal can bring the proposal forward, assuming that without the assumption of a third party offer. Another issue with the right of first refusal is that, again, that price is for the real estate, for the property. It does not include reserves or cash. So if you acquire the property at the right of first refusal price, you would go to the next step will be to dissolve the partnership, because in your partnership agreement, that'll be one of the items that is defined where the sale of the real estate triggers a liquidation event. And then typically, if you go through the waterfall, 9 times out of 10, you're going to see that, hey, at the end of the waterfall, the limited partner is going to get all of anything that's left over to get distributed, which would include cash and reserves. Now, I'm going to go into it a little bit as I go through this training, but the reason that occurs is there's a waterfall, and typically the last item on the waterfall will be that whatever cash and reserves or whatever cash is remaining will get distributed per capital account balances. And by nature of these investments, the limited partner's capital account is typically larger than the general partner's capital account. And if it can be significantly, it might be 99%. So the right of first refusal, you have to go through the math to understand it and make sure that it really makes sense for you to do that. There are times it makes sense, even if we just follow the partnership agreement and no negotiation, and it just follows the actual agreement, where capital accounts have been adjusted over the years and there's been gains and losses and everything get adjusted out, where the general partner looks at it and says, that this right of first refusal still makes sense, even if I have to give up some or all of the reserves. But that is a hot button item, and we're not going to go into too much about what's the litigation is going on across the country about it. But I mentioned liquidation, and this is pertinent for the right of first refusal and the buyout option. If the general partner is acquiring either the property or the LP interest, they may or may not intend on liquidating the partnership. Enterprise does entertain and be successful taking this to the investors, the idea of the general partner can exercise the right of first refusal, but structure it as a transfer of limited partner interest. So ultimately, what we decide is like, hey, if we can go to the limited partners and say, we're going to give you, or the limited partners is going to get the same dollar amount that they would if they exercise the right of first refusal and liquidate the partnership. But we're going to structure it in such a way that the partnership doesn't have to get broken up. We can just keep the partnership as a going concern at a price and sell the LP interest at a price that the investors would have gotten for the right if we exercise the right of first refusal. That said, and I know that's a mouthful. Some states have pushed back, and there's litigation that, hey, this is not really a liquidation event. And if it's not a liquidation event, that in some locales they may say you can't follow the waterfall per se and rely on capital account balances to distribute final proceeds. It's rare right now. So if I would, if I'm doing this calculation as a general partner, I would be ready to go with the higher price. Look at the fact that, hey, I might have to give up reserves. I might have transaction costs if I actually do exercise the right of first refusal. So it's best to start out with a clear understanding of what you're up against. If you go that, you might have some pushback from some investors and/or syndicators.
Hey, Sean?
Yep.
Oh, sorry. There are some questions we can save towards the end, but one relevant question about the bona fide offer in particular. Can the local HFA make an offer in lieu of marketing the property widely?
Yeah. I don't see a hurdle there.
I agree. I expect it probably needs to meet some state requirements for what a bona fide offer is, meaning, and that usually means that the entity making the offer would actually be willing to execute on it.
Right.
Yeah.
Is that it?
Yeah.
And then, as I'll show you in one of my examples here, or one of our case studies, the formula price, the debt plus exit taxes, might exceed the fair market value. So it might not make economic sense for you to exercise the right of first refusal. But you really have to crunch the numbers just to get an understanding of where you stand. It sounds great, but it might not always be the best strategy to take if you have a right of first refusal. And the buyout option. This one is also a hot button item across the country. This is a defined price, and it's typically the greater of the fair market value of the partnership interest, the limited partnership interest, or unpaid tenant benefits plus taxes. Now, I have here in parentheses defined as the sale of property and liquidation of partnership. It's a defined term in our agreements. So fair market value is capitalized. If you have an agreement outside of an enterprise deal, you might want to look at that and see if it's lowercase letters, maybe it's not a defined term. Maybe you just go out and get an appraisal and liquidate the partnership in a means outside of the partnership agreement. But if you follow a typical agreement, it'll have, you have to bring, if you want to make a buyout option proposal, you have to bring an appraisal of the real estate. And then essentially you're going to take that appraised value and act as if you're liquidating. So you're going to sell the real estate, you're going to have costs associated with selling it, you're going to have other assets that you can add to the net proceeds from the sale of the real estate, you're going to deduct all liabilities and debt, and you're going to come up with a dollar figure that's going to get distributed ultimately by the balances of the capital accounts. So if, for example, if the general partner has, if there's a $100 capital account and the general partner has $25 and on their capital account, and the limited partner has $75 in their capital account, 75% of any distributable proceeds is going to go to the limited partner. Again, that's driven by the nature of these investments. The limited partner put in all the equity up front. So that does create significant value. It's typically skewed towards the limited partner, again, because of how they're structured. The pushback across the country is, hey, is this really a liquidation event? Like I mentioned earlier. But if we follow our documents, that's how we have to do the calculation. Now, it might not make economic sense, and then it turns into a negotiation. But if we're The first step, just like the right of first refusal, is to go through the math as it's written and go through the waterfall as it's written in the partnership agreement and determine what that number is. If it makes economic sense, go with it. If not, you might turn it into a negotiation if you have that ability to do so in your partnership agreement. And then we also have early exits. Early exits today are sometimes a good means of either positioning the project for activities going forward, if you will, repositioning, I guess the word is, if you wanted to bring in more capital into the project, or you want to refinance and you want a limited partner out of the way, or if you're trying to mitigate exit taxes, that's a means of getting a limited partner out of the way so that and maybe decreasing exit taxes or decreasing your exposure to exit taxes if you were going to exercise a price that's based in part on exit taxes, such as the buyout option. And the right of first refusal has exit taxes in the price too. So there may be a compelling reason why you want to mitigate exit taxes. Early exit is a means by doing so. It can be an onerous process, the early exit process. So I'd recommend reaching out to the limited partner sooner rather than later. We no longer require a bond per se. Most investors don't. But we do require an indemnity agreement, which would indemnify the current limited partner against any recapture event that would happen through year 15. And it's pretty straightforward, the indemnity. We haven't had any pushback on it. The big issue there is whether the indemnitor has the financial capacity to cover what we calculate as what a recapture event would look like. And it's discounted for the probability of it happening. But the groups that we have that do an early exit like the process, especially since the bond is not required. But it does take time, and it does depend on your stakeholders. You know, if your fund a multi-investor fund, if there's 15 investors in the fund and you want to do an early exit, I highly recommend you come with a compelling reason, because it's going to be very difficult to get 15 investors on board, and especially if there's consent required, and we have to get two-thirds consent, which means they got to put their pen to paper. And if it's a small shop, if it's a small investor, or if they don't have an appetite for any change over the 15 years, these were envisioned as 15-year investments, then it can be difficult to get through 15 investors, or any 10, 12, 15 investors if it's a multi-tier fund. So that's something you want to ascertain early on in your discussions with your 15 team, your syndicator.
Hey, Sean?
Yes.
We have a question on early exits. Do we see surety bonds used in early exits anymore? And I think that's synonymous with disposition bonds. I can probably answer that. We have not seen too many of them in enterprises, policies, and procedures. We are typically able to proceed with an early exit with an indemnitor signing an indemnity agreement protecting the investor against future recapture events, and just reviewing that entity's financial capacity to back that guarantee agreement. However, in some circumstances, be it maybe a single investor's requirements, or for other reasons, we have seen some disposition bonds used, and some people certainly do seem to like them as an option.
Well
and
said.
then yeah, and then I think I've seen a raised hand or two. I don't know if we have the capacity to allow individual attendees to speak, but please feel free to type questions in Q&A and we can try to address them.
Great. All right, so now Erica is going to take us through capital counts and exit taxes.
Hello, everyone. I'm Erica Maxwell from the Tax and Regional Accounting Department, as Sean had mentioned in the beginning. I'm going to be discussing with you, or going over the capital count and exit taxes. Our role in the Tax and Regional Accounting Department is to protect the limited partners' capital counts throughout the compliance period. We want to ensure that the investor is receiving the benefits that they paid for. So that's extremely important. We don't want to, go negative at any point where we can't sustain the losses and the capital account. So this first slide here is just basically telling you what the capital account balance or what the capital account is comprised of. And you have the capital contributions, less distributions, less the taxable losses, less historic credits, if applicable. All partnerships do not have the historic credits, as we know, and then less the syndication costs. The limited partner can sustain, or if they do go negative by chance, they will be able to continue to take losses if there is minimum gain. If minimum gain exists, which is the non-recourse debt less the net book value of the asset, then the limited partner can continue to take losses up until there's no longer a minimum gain available, or until the well, and as long as the minimum gain is available. That's if they go negative prior to the end of the compliance period. And of course, we're looking at the tax basis. We're looking at these numbers based on tax basis and not GAAP. Next slide. So here is basically just talking about how the limited partners capital account must be zero at disposition in order to transfer the interest. If the beginning balance is positive, then we're going to write off that balance by recording a negative amount. However, and that's what we want to see. But if there is a negative balance, then we're going to have to make them whole, make that account whole. And by doing that, it will, or in order to make them whole, we will record a benefit there. And that's going to trigger a tax event or exit tax. And when I know a lot of us or a lot of you want to avoid having these exit taxes, but exit tax will be triggered, and the time value, the time value of money, basically just, we all know that means when, the money in hand is worth more than what it's going to be later on down the road. So in this case, it's going to be some years from the time that these funds were put in. So the value is going to be more. Next slide. These are just a couple of samples. So in this example here, it's showing that the capital account is going to remain positive throughout the compliance period. And this is ideal for any property or partnership. We would like for the capital account to remain positive throughout the compliance period, because then we won't have to, there won't be any exit taxes at the end. And we won't have to worry about trying to figure out how to, we'll be able to take all of our losses, and the investor will receive all of their benefit that they paid for. So this is an ideal, scenario for the limited partners capital account. Next slide. This scenario is showing the capital account going negative, but it's after the credit period. In this case, the limited partner may or may not be able to take any additional losses, depending on, as I mentioned before, if there is minimum gain. If their minimum gain does exist, then the limited partner will be able to continue to take losses, meaning that, well, let me back up a little bit. The investor has received all of their benefit once all the credits have been received. So in this case, the investor has received all of their benefits. The limited partner does not have any more capital, and in that case, cannot take any additional losses. In this instance, we would require or request that any losses that would normally be given to the limited partner be given to the general partner. So we would ask you to give the limited partner's losses to the general partner, and that way, the limited partner's capital will stay at 0 and not go negative, which the limited partners cannot go impermissibly negative. That's in the LPA agreement. However, if there is minimum gain, then the limited partner can continue to take their losses as long as there is minimum gain, and the general partner will continue to take whatever percentage it is that they own, which typically is 0.01%. And in that case, this will be an ideal situation as well, because the limited partner's capital account will remain, will not go impermissibly negative. And that will not generate any exit taxes. Next slide. This is the last example here, which is the limited partner's capital account balance goes negative in looks like year 9. And as we know, the tax credits are delivered over anywhere from 10 to 12 years, unless for whatever reason, we're taking them over the 15-year period. But typically, we deliver credits over 10 to 12 years. And in this case, the capital account balance goes negative in year 9. And this is a problem. If the limited partner cannot take losses, then the limited partner will not receive their benefit or their credit. And as you see at the bottom of the slide, it says the credits follow depreciation. If the limited partner cannot take the losses, then they may lose the credit. So we don't want this to happen. We want to try to avoid it as best as possible. And some ways that we avoid that is by having, if there's related party debt on the books, we would ask the general partner if they can forgive some of that limited partner debt, or related party debt. And if they do, usually they do that, and that would give us some additional leeway so that the limited partner can take credit throughout the last couple years of the credit period. And once we get through those last few years of the credit period, then we can just any losses that would typically go to the limited partner, as we spoke about in the example 2, would be reallocated to the general partner. And we're okay because our limited partner or our investor has received all of their benefits. Let's go to the next slide. This is an example of how to calculate exit taxes. Not going to read through the example verbatim, but basically it's your sales price equals the debt plus exit tax. And in this example, you see the limited partner's capital account has a negative balance of $500,000. So you would take that $500,000 and multiply it by the federal rate. In this case, it's 21%. And that would give us $105,000 of exit tax. If the general partner if the general partner makes the payment of exit taxes, it will create another taxable event. And that would, you see that calculation here, which is the 21% of the exit tax amount of $22,000. And then here's your total exit tax at the end. So the negative capital account will give rise to the taxable gain on an amount equal to the negative capital account. Some or most of the partnership agreements require that the general partner pay the limited taxes, pay the limited partner's exit tax. And then you see here, it mentions the gross up factor. The gross up factor is basically just another way to calculate exit tax, and it varies by syndicator. It's literally just calculation, and it's always a one-time gross up. We can go on to the next slide. Here are some ways to manage exit taxes. And it's important that this is done prior to year 15, because at year 15, it's too late. So we recommend, looking at this from between years 11 and 15. And the first one here is forgiveness of debt. And when we speak of the forgiveness of debt, and I actually had mentioned that before to help provide us with an allow us to be able to take the limited partners to be able to take some additional losses so that they can take their credit. We're only speaking of.
Hey, Erica.
Yeah,
So, sorry to interrupt, but a few people noticed, and I noticed as well, the sound suddenly went a little quiet.
Oh,
I can
sorry.
still hear you, but it just went quiet, in case maybe you want to try speaking up or just seeing if your connections work.
Okay, I'm sorry about that. Can you hear me better now?
Yeah, it's good for me.
Okay. If you see that, just let me know and I'll stop and go back.
Great. Yeah, sounds good to me. So, yeah. Oh, yeah. Better now. I'm hearing a few comments. Yeah.
Okay. Good. So forgiveness debt, we are speaking specifically about related party debt, which if there's forgiveness of the related party debt, it will create income, which then decreases the losses and potentially increases the capital count and or slows down the losses. That's very common. That's a common way to mitigate exit taxes. The next one is reduce the LP's interest by a third. This would occur after the credits are delivered, and it happens on the back end of the compliance period. Sometimes an amendment will occur for this. We've actually started seeing this request or this negotiated during the underwriting period. It's noticed usually during the underwriting period in the projections that this partnership is going to go impermissibly negative, or the capital count will go impermissibly negative in the later years after the credit. So this sometimes it's actually being negotiated at times in the beginning during underwriting. And that's the way to avoid having to deal with it later on down the road. Our next bullet is related qualified non-recourse debt and or added securities to debt. So in order to mitigate the issue or lowering the exit taxes, we need less minimum gain so that we're able to make non-recourse loans recourse. Then we have the capitalized rather than expense repairs. So in this instance, if you have some capital, some repairs during a year, And at the end of the year, your auditor comes in and typically your auditor will come in and they'll review your capitalization policy. And then they would make some suggestions based on whether certain items or certain repairs should or could be capitalized. And by doing this will slow down your losses because you're removing them from your expenses and moving them over to the balance sheet. And then the last bullet here is improve operations. By improving the operations, it's self-explanatory. You want to, try to reduce your costs or reduce your expenses, which will help to slow down your losses, and in turn, avoid you from having possible exit taxes.
Erica, we have a question on the second bullet point about reducing the LP interest by 1/3. Where does that 1/3 amount come from specifically?
Reducing the LP interest by 1/3. You want to basically, it's changing the limited partner's ownership from, typically our limited partner is 99.99% owner, and then your general partner is 0.01%. So at this time, they would change the limited partner to 70% or close to, and then the general partner ownership would be 30%. So any losses going forward would be 70% to the limited partner, 30% to the general partner.
Could other splits of ownership be negotiated other than the 70%?
I don't know that answer right off. I've never experienced that or seen it, but I would say it's probably possible. That's something that I would need to ask about.
And another question related to basically reallocating losses in year 11. Do any of our limited partnership agreements automatically contemplate for that?
Reallocating the losses? That's where you would see, that's where in the projection, sometimes you'll see like towards the end of the year 15, probably maybe year 13, 14, 15, you'll see where the losses have been reallocated to the general partner, because we had anticipated, or we noticed that when we were doing the projections in the beginning, that this deal was going to run negative. So yes, it does happen. You will see it at times in the LPA, in the projections.
And I guess if the limited partner doesn't have any more minimum gain, the losses have to go to the general partner.
They
right?
have to go to the general partner. They have to go to the general partner. Now there are times when, the general partner, they cannot sustain any additional losses either. So then we have to come up with some other options and ways for our investor to receive their benefit. And at times it's, a matter of the general partner having to pay for those credits. So it's cash in lieu of credit, basically.
Thank you, Erica. This sounds like a lot of intense calculations and everything. And then, as Erica mentioned early on, Enterprise does monitor the capital accounts throughout the life of the partnership and can flag any issues that come up. But at the end of year 15, or when we approach year 15, it's almost too late. Like the capital accounts are what they are. But if you make the decisions early on and you're monitoring your accounts, and maybe you reallocate some losses or whatever, sometimes it may benefit the general partner, and obviously benefits the limited partner because they can't, for example, if you can't take any more losses. But I'm working through a deal right now where the exit taxes, everything was reallocated a few years ago, and the general partner had actually put in some more capital. So it wound up with there being no exit taxes because the limited partner account was stopped at zero, could not go negative. There was no minimum gain. And so therefore the this group had a right of first refusal. The right of first refusal price did not include taxes because there weren't any. And their capital account was larger. So at the end of the day, they were able to acquire the LP interest because we did structure this, or we're going to structure it as an LP interest transfer. They're going to buy it for $1 versus considerably more had the capital accounts hadn't been monitored and the right actions taken. So now we're just going to go through a broad overview of what a year 15 plan looks like. Now, if you're in year 15 and we're talking about year 10s through 13, don't get nervous. Just start where you are. Ideally, you want to get started earlier because some of these issues do take time, but it's not at the end of the world if you're already in year 15 and you're starting the process. But we want to develop a plan early on that's not only going to take us through year 15, but also beyond. Most of these projects have extended use, or they all have extended use of at least 15 years. So you want to make sure that your plan will take the project through the extended use period at a minimum, and then hopefully forward. In other words, your cash flows are going to be maintained and the property is going to be maintained. The beginning of the process doesn't entail figuring out when year 15 is, and I already went through that calculation. But again, getting to know your stakeholders. If you're the general partner, what's your perspective on going forward? Do you have the capacity and the desire to stay in the deal? And if you're the limited partner, the investor, what's their perspective? Are they flexible for a sale or a transfer of LP interest? Will they negotiate outside the LP interest? And part of what's going to drive the answers to those questions will be, have their benefits been realized? But as Erica mentioned, with the time value of money, if there's a shortfall in delivery of benefits, given the adjustments made for time, it may be very difficult to make a dollar for dollar adjustments. That may come down to a negotiation. So again, that comes down to the stakeholders' perspective. You want to take a close look at your property, again, as early as possible, year 10, 11, 12, to see what your cash flows look like, to see what the financial economic health of your property is. Can it sustain future operations? Are you going to have any rental subsidies or tax abatements that expire? We see that a lot in the Northeast where tax abatements do expire. And from time to time, the loss of rental subsidies, and can they be renewed? Can a tax abatement be restructured as a tax and a pilot agreement or something where you can cover your tax exposure on an annual basis, your real estate tax? And you want to look at the market conditions, and not just for the sale of your property, but the rental conditions. Do you have another multifamily project, in particular for affordable families, coming into your neighborhood that's going to impact your operating success, your occupancy rate? And you obviously review the capital needs of the project, because this is what's going to determine what you need going forward. Now, we highly recommend getting a green CNA, which will take into consideration the efficiency of the building. Not only will it take into consideration the efficiency of the building, but it's popular today, and people want to live in green properties. So what would it cost to convert your property to a more green, sustainable property going forward? And we just reviewed how we would review our capital accounts, but that's really imperative. Even though at year 15, our capital accounts probably are what they are, they're not going to change over the next couple of months significantly. There will be some adjustments that would be made upon a sale, and they may be based on those capital accounts. So you want to make sure the capital account balances. So you want to make sure that you have a clear understanding, have the conversation with your accountant where you stand in regards to your tax capital accounts. Now, this slide has a lot of bullet items, and they're all important. So I'm not going to read through them, but there's a couple things that really jump out. Is your public purpose that is number one, it's going to probably require some type of consent process to go through. So if you do have public purpose debt, soft money, et cetera, get in touch with those lenders to find out what type of approval rates they need. There's times it can take 6, 8, 12 months to get through that process. But in order for them to give consent, perhaps they want to add affordability restrictions to the consent process. So that's important to understand. As I mentioned earlier, you want to look at your operating agreements to make sure, or your operations, excuse me, to make sure that your loans aren't going to be coming due at the end of day one of year 16, and you don't have the funds or the ability to refinance. If your loans can be assumed, forgiven, or restructured, I would highly recommend that you would perhaps poise everything to happen at the end of year 15 or early year 16, in particular with the forgiveness or restructuring of debt. But I would highly recommend doing that after year 15, after you get the limited partner out. And the reason being is, number one, you're going to need limited partner consent, and that can be a timely process. Number two, you might change the value of the value equation to your partnership. If you're going to forgive a bunch of debt, number one, there's going to be income to the limited partner, phantom income. But there's also going to, on paper, it might look like your property has more value. So it's more flexible. You have more flexibility, and it's best for both sides of the equation to do any type of restructuring or refinance event after you get the limited partner out. I see a raised hand. Is that a question, or would you want to hold that off?
Yeah, if anyone has questions, if you could put them in the Q&A.
Okay.
I'm not sure how to allow individuals to talk that are not panelists.
Yeah, I think if we, at the end of the presentation, if we have time, we'll go ahead and open up to verbal questions. But in year 13 and 14, hopefully no later than year 14, you have a good idea what your purchase price is going to be per the buyout option or the right of first refusal. And then you can internally make the decision, does this price make sense? Does a buyout option, does that equate to what's the true value of the LP interest? Or is a right of first refusal taking into consideration the loss of cash and reserves? Does that make sense to follow that route? And there are several ways to get sources to meet the purchase price and your capital needs, and they're listed here. Pretty straightforward. Refinance with conventional or soft loans. You do have reserves that are going to be yours to use, so that's you can use those funds to finance the LP exit. And you can have combinations of weather and weatherization grants that are available for capital needs, for example. And in year 15 in particular, you want to meet with your accountant and your attorney and meet with your syndicator like you're doing today, meeting with us if you're our syndicator or if we're your syndicator. But again, make those phone calls earlier rather than later to get everybody on board which direction you're going to go. We typically negotiate the exit price in year 15 or close to it. And for enterprise deals, for our letter of intent is simply an email that outlines what everybody's responsibilities are, who's going to pay exit taxes, who's going to pay transfer taxes if there's a sale of the real estate, who's responsible for lender approvals, and then we'll draft the documents to take the limited partner out and bring in a new limited partner into the deal. And we do strive to get the limited partner out by early year 16. If a certificate of limited partnership is applicable, we ask that to be executed, as well as following the final tax return and K1s for the limited partner. And we have two simple documents to get the limited partner out. One is an assignment agreement, and the other is just an amendment to the partnership agreement. Both of these signed by the withdrawing and new partners to get the limited partner out of the deal. So that's a broad overview. And everything we've been discussing here really is things that you discussed about or thought about in year one fully, and you should be thinking about them now going forward. If you approach year 15 as the beginning, really, because you are beginning, now you're beginning a new life without the current limited partner, but you still have a compliance period to get through and future operations to get through. So a lot of the same issues are going to be addressed. What's the financing look like? How long will rent subsidies last? Do you have any ballooning debt, like I mentioned? What type of condition are the improvements in? Do you have significant capital needs, whether green capital needs or just straightforward capital needs, physical capital needs? Do you have a full understanding of what happens at year 15 as far as the buyout option or the right of first refusal or anything else that's in there, or if there's a put option, for example? Do you understand what those documents spell out comes year 15? If you're doing a new deal, make sure that you structure those so that everybody knows what happens at year 15. Because even though year 15 does go by quickly, when you're looking back at year one, a lot of the same people might not be around in 15 years. So you want the documents to be as clear and concise as possible. and consider the exit tax proposal or projections, excuse me. Like Erica mentioned, that a lot of these are projected in. Sometimes they are projected to go negative at a certain point. But as long as everybody has a full understanding of where they're going to be at year 15, estimated to be at year 15, and then where you're going to get the funds to pay for that exit tax. Now, I have two case studies that I'm going to go through here that's going to hopefully highlight everything we discussed here. The first case study is probably our typical deal. And even across the country, as that HUD study had indicated, most of these partnerships at the end of year 15 have limited or no value, and they get transferred to the current general partner. In this case study number one, we have a deal. It's actually, I think we just closed on this. We have a deal in California that has 40 units to serve low-income seniors. There's the AMI is the area median income is between 50 and 60%. Building was placed in service in 2006. So I add 14 to that and I get an end of a compliance period of 2020. And they happen to have use restrictions that last an additional 15 years, which is kind of unusual. In a lot of the California deals we see it's considerably longer than that. Now, the stakeholders, obviously the general partner, it's an established nonprofit. They have the mission of providing affordable housing in their region. We have a single investor fund as a limited partner, and we enterprise, we are the syndicator. They do have conventional and public purpose debt, so there's going to be some, or there were some consent requirements by the soft debt lender. State allocating agencies were important in the beginning, and they're important now, especially if you want to do some type of re-syndication. And first and foremost, our residents. We want to make sure that it's a seamless event where they can maintain their occupancy and stay in safe, affordable property. Now, some of the points of the negotiation in this deal, number one, they had its right of first refusal, and they could purchase the property for debt plus taxes. And the capital count for limited partner was slightly negative, so their capital, the exit taxes would have been $13,000. So if we were to exercise the right of first refusal on this deal, it would be the debt plus $13,000. General partner also had a buyout option to purchase the LP interest. Now, the buyout option typically won't make economic sense, especially in California or locales where the real estate is very expensive. And this case was no exception. It didn't make economic sense to exercise the buyout option. So they looked more towards the right of first refusal, but there was significant accrued debt that had accrued over the 15-year period. And they also had an accruing partnership admin fee. Now, this is one of those reasons why it's really important to look at your documents to make sure that you're covering all your accruals, for example. I have seen a few times where audits don't accurately reflect what the partnership admin fee balances are for whatever reasons. There's one particular deal, the accounting firm had a reason why, but that will have an impact on your value if that's accruing, especially if it's not on your balance sheet. And this deal also has significant capital needs. So this is an economic snapshot of property. This is what Laura and I and our team start out with, really. We look at the economics of the partnership. Is there any value to distribute it to the limited partners? And that's will change. If there's no value to distribute to the limited partner, the conversation kind of changes. Our decision tree changes, if you will. The way we determine value is straightforward. If you're familiar with the direct income capitalization approach to valuing a property, is what an appraiser would use. Essentially take the net operating income divided by a cap rate, and the cap rate is derived from the market. What appraisers go out there and look and see what the cap rates are typical for a typical transaction in that area, or what they amount to. We have come up with a value of the real estate. We add that to all the other assets. Here it's the operating reserves, replacement reserves, escrows, and cash in the bank, and we come up with 629 for that figure, 3.5 for the real estate value, and we subtract all current liabilities and long-term debt. And if we do that, you'll see at the bottom here, we have net assets of minus 4.7 million. So from my viewpoint, and again, we don't have put agreements in our partnership agreements where you have to pay exit taxes or something like that at year 15. From my viewpoint, we look at this deal and say, hey, there's no value to distribute here. Let's make a recommendation to the fund that we transfer our limited partner interest for no monetary consideration. And that's what we did with this deal. And this is probably 75 to 80% of our deals for the nature of the way they were set up with heavy rent skews for affordable tenants or for needy tenants, low-income tenants. That these properties aren't really projected to have value at the end of year 15. And this one also had accruing soft debt, which wiped out any conceded value. So we made a recommendation that we transfer for $1. This meets the business purpose of the fund, which was to provide for long-term preservation of these projects after the fund exits. The investor funds or investor benefits were delivered. The IRR for the internal rate of return for the fund has exceeds target, which is typical in our deals. They did have a right of first refusal, but it doesn't make sense. If the value of the real estate is 3.5 and the value of the debt is 8.4, and you're going to give up all your reserves, why would you go that route? And if we did this transfer for $1, the general partner is going to assume all assets and liabilities, and they're free with their new limited partner to continue operations going forward and to keep the project viable and healthy.
And Sean, just a time check. We are going to try to wrap up within the
Yes.
next 15 minutes or even less, but I did want to quickly ask, would you have negotiated something differently for that deal that was underwater by 4.7 million if the sponsor was a for-profit?
No, probably not, because again, because the debt exceeds the value of the real estate. Like this is just a real economic snapshot. So this, regardless of who owns the project, this value does not have value in excess of debt. So what is there to really distribute? If I was a for-profit, I'd be hard pressed to pay $100 for something that's worth negative 4.7. And they don't. If you look at the economics of this partnership, like, hey, where are they going to get the funds? They can't refinance and do cash out because debt is twice the amount of the value of the real estate, so they can't do a cash out refi. They don't have enough reserves to close that gap. Arguably they have enough replacement reserves at 175,000 to cover 40 units for a little while. But to me, I think for the most part of our team, when we take a quick look at this, we haven't even considered a buyout option or a right of first refusal. We know there's really nothing to distribute here, and we would make this recommendation, which benefits the fund. There's no reason for this fund to stay in the deal, and obviously benefits general partner, gets the limited partner out and lets them hopefully recapitalize in some other fashion to keep operations going forward.
And do you still include the reserves in this calculation if the state housing agency requires the reserves to stay with the property?
Yes, especially in California is one of those states that they do have a pretty strong hold on them. But let's say there was let's say there was enough value that the only thing that was left over would have been, let's say the property is worth 8.4 million. So the only thing to discuss would have been the reserves. There may be significant restrictions on who can get those reserves. And California is one of those locales that do have, through TCAC, that do have some restrictions on those. As a matter of fact, my next case study is on the other coast. It's the Northeast, but that also had, as you'll see, have significant restrictions on the reserves. So again, it made sense to the fund to exit in this for $1. Now, our second case study is a nonprofit with a right of first refusal that does have equity in the real estate. As you'll see, it's significant equity. They have a lot of long-term equity built up in the property. It has 221 units serving seniors 60 and over with and/or disabled tenants. AMIs range from 30 to 60%. This building was placed in service in 2003, and the compliance period expired in 2017. So yes, this was what we call a deferred exit. The reason it was deferred is, number one, getting the general partners their internal organization decide what they wanted to do going forward. They did have a nonprofit entity within the general partnership entity. And it's actually, I guess the general partner was a nonprofit. They also had a for-profit involved. Extended use restrictions are significant. They go on through 2048. So whatever happens at year 15, this project needs to maintain operations for a long time. Now, this property does well, but there were some significant negotiation points that we had to work through, and it's part of the reason it took a few years to get out. There's a lot of equity, so they could refinance and recapitalize the project that way, but they have a right of first refusal to buy the real estate for debt plus taxes. The agencies that are involved have very strongly worded documents that restrict how funds can be used, and they're very upfront and forthright with the fact that, hey, they can't go to buy out the limited partner. So the partnership resources could not be used to buy out the limited partner. Now, not only was this in the documents themselves, which through our due diligence we review, but we actually reached out to the agency for clarification, say, what gives you the right to restrict everything to that extent outside of these documents. And the documents did do a good job of showing how those reserves were locked down, but I just wanted more belts and suspenders. I wanted to be able to show, make sure we're all on the same page, that there's nothing to distribute if you were to have if the right of first refusal was to be exercised. Now, when I go through the economics, I'll point to you how a buyout option was available, but it would not make economic sense to this partnership if they had the right of first refusal. Why would you exercise a buyout option if you can buy the property for debt? There are a lot of regulatory agreements that are involved in this deal, so it's part of the reason why it took so long. And we also have, even though the part of the entity was a for-profit, they were a long-term preservation owner. They have no economic desires outside of to provide mission to the partnership. They want to provide affordable housing to their tenants going forward. So all those things came into play in the year 15 exit. And ultimately, it really took I think more onus on the general partner was to keep moving forward to make the proposal that would have made economic sense to everybody involved. So this is what the economics look like in this snapshot, if you will. We have property NOI of 757 here. This is pre-COVID, so the cap rate is around 6%. Divide the NOI by the cap rate, we come up with the value of the real estate at 12 million. We had cash and reserves of approximately 1.8 million. We subtract all long-term debt and accruals, and we come up with the net assets of the partnership of 5.2 million. Now, if they were to exercise the buyout option, they could get, you would run that $12.6 million figure through the buyout option waterfall or the liquidation waterfall, and come up with how much the limited partner would get, and was very significant. But almost most of 99.99% would have gone to the limited partner, so it wouldn't make economic sense. Important points here are there's a lot of cash, and it's common for deals up in this area. Cash and reserve balances are big, and there's a lot of equity. They could do a refinance event to take out the equity. So if we do the calculation for the right of first refusal, the sale price of the property would be debt plus taxes. We have wind-up costs associated with exercising a right of first refusal, when these reflect accounting fees and legal fees to wind down the partnership after the real estate is sold. We subtract debt from that. We come up with total, and add other reserves, we come up with total proceeds upon the sale of 1.4 million. Now, again, as I mentioned, the limited partners capital count was significantly, it's pretty much everything, 99.999%. So the general partner on a liquidation event would get nothing, whether it's a buyout option or a right of first refusal. If everything's driven by the capital counts, no money would go towards the general partner. I might have said limited partner gets nothing, but the limited partner would get it all. So obviously that doesn't make economic sense to anybody, to the general partner. They don't want to give up $1.4 million, even though they're getting a lot of equity in the real estate. Now, if these reserves weren't locked down, and to get to Laura's question earlier, I would look at this deal and say, hey, there's a lot of equity there. It makes sense, you general partner, to don't fight too hard over the cash and reserves, because if they are distributable, you can turn around and refinance your property and get plenty of money to pay off the cash and reserves. And if I'm just going to follow the right of first refusal verbatim as is outlined in the partnership agreement. But because of these restrictions on cash and reserves is not the avenue that we ended up going. The public purpose lender did have significant restrictions on the reserves, and there's no motivation for them to refinance the largest loan on this property. Their interest rate was 1%. So they don't have to refinance. There's nothing in a partnership agreement that says they have to refinance. If it means giving up a lot of your reserves in cash, why would you refinance? And they also had, like I mentioned earlier, significant capital needs through 2048. So the general partner in this deal is very motivated to keep resources in the partnership or do nothing because of that 1% loan. So now if I look at that right of first refusal calculation, and after doing our due diligence, we look at the total proceeds of 1.4 million. We know that the lender is going to restrict those reserves that are not distributable. If they exercise the right of first refusal, there's going to be nothing to distribute. So we made the internal recommendation that we transfer our limited partner interest. We're going to structure the deal as a transfer of limited partner interest. Actually, it closed yesterday or 2 days ago for $1, because there's nothing to fight over here. Nothing can get distributed, and it makes sense for the partnership. It makes sense for the investors, even though you're looking at that $1.4 million figure and think, wow, it's a lot of money, but you know, the property needed it, and they had the right to it per the regulatory agreements and the partnership agreement. And that's the deal we struck. And from the fund's perspective, again, we're in the business to provide long-term preservation after we exit. So we're leaving resources in the partnership. The investor benefits were delivered, and the internal rate of return does exceed target. And they do have that right of first refusal in their partnership agreement. So at the very least, we know we're not going to capture that, the equity in the real estate. But again, because of the regulatory agreements, we're not even going to capture any cash or reserves. So we made the recommendation to transfer for $1, and the general partner is going to assume all liabilities and assets. And it's a deal that I particularly like going through, even though it took a long time, was because this is a mission-minded nonprofit up in the city where they're located. And it's important to keep this project affordable going forward. And the limited partner did receive their benefits, and I think it was a great outcome for all, even though it was deferred. And this slide just shows some of the major takeaways from today. Like I mentioned, most of the GP interest or the LP interest do go to the current GP. I highly recommend you get that mantra in your mind of knowing your property, knowing your documents, knowing your stakeholders, and develop a plan. The hypothetical versus actual liquidation is something you're going to hear more and more of. Internally, we start with this hypothetical liquidation to do our calculations. I mentioned some states, there's some pushback on that, whether that's the correct way to do it, but we just follow the documents, and that's our starting point. We don't have any put agreements, so we don't have to stick by that, but you need a good logical starting point for your negotiations. Again, make sure you reach out to your lenders early to make sure you have enough time to get agency consents if you're going to do a year 15 transfer. As in this second case study here, the agency restrictions can significantly impact LP value. So when I do see value in a deal, and I have a first conversation with the general partner, I recommend to them that they pull out their documents and see if there's any restrictions on cash and reserves. And then the extended use period will drive the need for these properties to be well capitalized going forward. So we take that into consideration, in particular for a negotiation over price, that we know that these projects are going to need cash going forward, depending on how long their extended use period is. And now we're going to open it up to questions and hopefully good answers.
Yeah, we got 1 minute left, but I think if everyone else can stay on, we can continue to go through the questions to the extent others can stay on the line. So I'll just get right into it. Sean, I have one question about someone who's dealing with some investors that seem very profit motivated, and do you have any suggestions on how to deal with a particularly profit motivated aggressive investor?
So I think number one, I would be realistic about what you might have to part with if you have value in your partnership. So even if you keep those numbers internally, do your calculations, get an appraisal of the real estate. If you get an appraisal of the real estate versus a BOV, I would highly recommend you get a capital needs assessment first. And I would recommend getting a green capital needs assessment because they're more expensive and they're going to show a higher dollar amount of capital needs. But give that capital needs assessment to the appraiser when they show up at your property. If they have that in hand, they can make a more accurate representation of the condition of the property. If you do it after you get the appraisal, it's not the end of the world, but it does make the discussion more difficult. So start out with a realistic indication of value, get an appraiser involved, get capital needs assessment. Look at your agreements, make sure you understand what type of restrictions on what could get distributed, and express your motivation to, hey, we want to get you out now, get the limited partner out now. Here's what we think the market value is. This is why we need to keep certain resources in. For example, if you need to get replacement reserves need to stay with the property, come up with a sound agreement. You can't just dig your heels in and say, I'm not going to give you anything, especially if you have equity in the real estate.
Yeah, I agree. I think our mantra is helpful from a high level of know your documents and know your stakeholders. But we certainly at Enterprise have had dispositions we've worked on where there's a disagreement in pricing between the GP and the LP. And sometimes those can take years to get to a place where both parties fundamentally have to agree to move forward with the plan, right?
All right.
And then next question, is there a big difference between for-profit and nonprofit syndicators when it comes to dispositions?
Enterprise is the best. That's like Laura mentioned about getting to know your stakeholders. Yeah, I believe there is. I mean, there's some, if you do your research, you're going to see that some are more aggressive in their in chasing value at the end of year 15, or even perhaps going into the deal. Who you get into these deals with in day one is extremely important. So do your research, ask your originator, your underwriter, what type of funds are involved, what's their motivations at the end of year 15. Get as much of that information up front, because all syndicators are not the same and all investors are not the same. And if you do some Google research, you'll see there's a lot of lawsuits out there over it. How hard does a syndicator or an investor make it for a group to exercise a right of first refusal? Does the syndicator or the investor take into consideration the physical needs of the property? Do they go after all reserves, or do they leave replacement reserves and or operating reserves in the partnership? So that's all stuff that can get negotiated early on and should be addressed early on, because you don't want to wait till year 15 and hope that people change their minds. You want it spelled out early on and do your research, find out who's involved. There are what they call aggregators out there that have given a little bit or present a little bit of a black eye to the industry, but quite frankly, I would want to know, is there any aggregators involved in this fund that we're putting together?
Yep. We have a question about whether or not Enterprise in our limited partnership agreements have an option to do a charitable contribution, or whether we have experience negotiating that into partnership agreements, which I think might deserve a description of what a charitable contribution is.
So, Erica, tell me if I'm wrong, but a charitable contribution would be just if there's value to the partnership, make a donation, and then you would get a tax benefit. Donate the value of that partnership, and at the end of the year, you would get a tax benefit. The answer is we do not do that anymore, just because the market's changed. Investors aren't interested in that. But there was a time when they did that. And, that's the way it was typically structured. It was just, if there was value, that got donated. And the investors would show it as a donation on their balance sheets, but now investors typically are motivated to have a stronger balance sheet versus more charitable donations.
Someone is asking that we touch upon the tenant option. And I'm not sure that I'll kickstart that. We do have some limited partnership agreements that grant a right of first refusal to a tenant organization of the property. So we have seen that in if that right was granted up front when the deal was closed. But Sean, perhaps you could also speak to lease to purchase deals.
Yeah, and I believe the code does allow tenant agents or tenant groups to qualify for the right of first refusal per the code. And there are lease purchase deals are deals that are structured early on where with the goal being that the tenant would have the right of first refusal to acquire the property at the end of year 15. These are typically standalone or scattered site type of deals. And a personal favorite of mine because it provides home ownership at the end of year 15. So that's definitely a big benefit in some parts of the country where they have those type of investments.
And can you move on to the next slide with our contact information? I think some attendees would like to follow up with us individually. And with your last case study, there was a question about whether or not that project included a shared appreciation buyout if the property is sold, in addition to the lockdown on reserves. And I can't say I have any familiarity with the term shared appreciation buyout.
Yeah, I'm familiar with the term, but I read all those documents beginning to end because I knew there's a lot of due diligence involved there, and it did not have that. So it was just for the and I don't think I've ever come across any deals that we've had since I've been with Enterprise where they had a shared appreciation clause.
I think that is it for the questions. Unless anyone has anything else they'd like to type in at the last minute.
And we are available for questions via email. I should have capitalized Erica's name too. I apologize. But yeah, we're available by phone or email. Happy to answer any questions. Matter of fact, I already see some questions coming up in my email now.
Well, thank you everyone for staying a little bit late. It's a lot of content to cover.
And keep your ears open. I don't know if I mentioned this early on in the training, but we do these type of trainings across the country as 2-day events where you get it's actually hands-on. You would bring a deal to the training and we would help you work through it and come up with a strategy with us looking over your shoulder. We do those different locales. And they're we do 2 or 3 a year, but the locations are somewhat sporadic wherever we find the most need in that given year. Well, thank you everybody for attending. And thank you for my team.
Yeah, thank you,
Bye.
Sean.
Yeah, thank you, Sean.